This next problem is problem 5-28 on page F191. As you can see on the introductory paragraph, the company purchased $100,000 of inventory on December 15th on a 30-day account. It sold the merchandise for $35,000 in December and the remainder in January. The first requirement asks what date should the company pay for the merchandise. In the format on your screen, the date function is being used in Excel and a formula to add days. By putting the date 12/15/2004 into the cell next to the A, Excel actually puts a number in that represents December 15th, 2004. It displays the date, but the number behind the date can be used for calculations. In the next cell over, the number 30 is typed for 30 days. The next cell to the right of the 30 contains a formula adding the 12/15/2004 cell to the 30, which results in the date that the payment is due, 1/14/2005. Requirement B says to calculate how much of the $100,000 of merchandise appears in the costs of goods sold on the December 2004 income statement, and how much appears on the balance sheet and merchandise inventory on December 31st using the cash basis of accounting. This is pretty simple, since neither the payment for the merchandise nor the income from the sale are in the month of December. As a result, the December income statement shows $0 for this purchase, and the December balance sheet shows $0 for this purchase. Requirement C asks the same question, only using an accrual basis. To calculate what appears in the costs of goods sold on the December balance sheet, we look at the second sentence above where it says that the company sold merchandise that cost $35,000 in December. So the December income statement shows the costs of goods sold as $35,000. On the balance sheet for December, using the accrual method, we can actually use a formula. The company purchased $100,000 of material and sold $35,000 of material. So on the balance sheet, the answer is $100,000 minus $35,000, which comes to $65,000.